Hey everyone, welcome back to Corporate Decoder. Today, Dynamic Credit Fund, DCF just filed its semi-annual shareholder report, and I am seeing a few key numbers that paint a clear picture of its financial health. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report details their investments and financial performance for the first half of 2026 and will break down what those numbers really mean for the fund. Let's dive straight into the numbers. The fund's total net assets as of the 30th of June 2026 stood at a very solid $1,481,439,000. That is a substantial amount of money, indicating significant investor confidence and a large pool of capital being managed. Now, something interesting is the portfolio turnover rate, which is reported at 57.9%. This figure tells us how often the fund buys and sells its investments over a year. A turnover rate around 58% suggests the fund's managers are actively managing the portfolio, making adjustments to holdings based on market conditions or their investment strategy. It is not excessively high, which might indicate active but not overly speculative trading. When we look at where the money is invested, the biggest chunk, 43.5%, is in corporate bonds. This is a core component for a credit fund, and it means they are lending money to companies, expecting to receive interest payments and the return of the principal. Another significant area is US government and agency mortgage-backed securities, making up 14.3% of the portfolio. These are generally considered safer investments tied to the housing market and government backing. Among the top 10 holdings, UMBS, which stands for Uniform Mortgage-Backed Securities, is the largest at 13.1%. This reinforces the fund's focus on the mortgage market and government-backed securities. Following closely is US Treasury bills at 9.6%. These are short-term debt obligations of the US government, considered among the safest investments in the world. Having a good chunk in Treasury bills shows a conservative approach, providing a stable base for the portfolio. Let's talk about costs, because that directly impacts investor returns. For the Dynamic Credit Fund investor class, based on a hypothetical $10,000 investment, the costs for the last 6 months were $31, which is 0.63% of the investment. This is a relatively low cost, especially for an actively managed fund. For the I class, the cost was slightly lower at $27 or 0.55%, and for the Z class there were no costs reported, indicating it is likely for institutional investors or those with fee-based accounts where the management fees are handled differently. Looking at the income generated for the investor class, the net investment income per S-Hair for the 6 months ended the 30th of June 2026 was $0.33. This is what the fund earned from its investments after expenses. The total return for the investor class for that same 6-month period was 0.40%. This is the overall performance, including both income and any changes in the value of the investments. For the I class, the total return was slightly higher at 0.43%. The net assets section shows the breakdown of the fund's net assets. It is divided into total distributable earnings, which is a loss of $50,409,000, and paid in capital, which is a much larger positive number. This suggests that while the fund has distributed more than it has earned in profits over time, the core capital invested by shareholders is substantial. This note about to-be-announced purchase commitments is quite important. It means the fund has agreed to buy mortgage-backed securities in the future. The total value of these commitments is a significant $193,667,000, making up 13.1% of the fund's net assets. This shows the fund is actively looking to grow its holdings in this specific asset class. The fund also uses forward currency exchange contracts, and as of the 30th of June 2026, there was a net unrealized gain of $2,822,000 on these contracts. This means that the contracts the fund has in place are currently favorable, likely helping to hedge against currency fluctuations or achieve specific investment goals. The report also covers the approval of the investment management agreement. This is a standard but important part of these filings, showing that the board of directors reviewed and approved the services provided by T. Rowe Price Associates, Inc. They considered factors like the quality of services, investment performance, and the reasonableness of fees. This statement is particularly interesting. It highlights that the board's decision wasn't just based on the immediate data, but also on their long-term understanding of the advisory team. This suggests a level of trust and ongoing evaluation that goes beyond just quarterly numbers. Ultimately, the board decided the current management is doing a good job, as evidenced by their approval to continue the advisory contract. This is a positive sign for the fund's stability and management. Looking at the big picture, the Dynamic Credit Fund appears to be a Established and actively managed fund with a significant portion of its assets in corporate bonds and government-backed mortgage securities. The costs are reasonable, and the total return, while modest, reflects the market conditions for the period. The active portfolio turnover and the use of derivative instruments like forwards suggest a strategy aimed at managing risk and potentially enhancing returns. The board's continued approval of the advisory contract indicates confidence in the management team. However, the net distributable earnings being in a loss position does warrant attention, suggesting that while capital is growing, current income generation might not fully cover distributions. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe, and join our Discord community linked in the description.